And welcome to another episode of Taking Stock for the week ending the 10th of February 2023. I'm Trinh, and I'm the Head of Research at Stock Doctor. And joining me today is our Senior Equities Analyst, Jason Yin. Welcome, Jason.
Thanks for having me, Kien.
But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented shouldn't be relied upon as a guide for future performance. Well, welcome back to another exciting episode, Jason, where, it's been the first 2 weeks of reporting season, and so far results haven't been too bad, with many industrial companies signaling that inflationary cost pressures have passed its peak. Nevertheless, though, there has been an increased caution on the outlook statements. But before we touch on the company updates this week, let's quickly cover the RBA rate decision this week and the changes to market expectations moving forward. Australia's central bank, they lifted interest rates by another 25 basis points, which was in line with expectations, but bringing the official cash rate to 3.35%. So what does this mean for the share market, Jace?
Well, Kien, although the 25 basis point increase was in line with expectations, the market was a little bit unnerved by the rather hawkish comments from Governor Lowe. It now appears that the RBA is happy to keep increasing interest rates in the short term, which is a risk because it's not being priced into current market expectations.
Yes, and higher than expected rises in interest rates tend to weigh on the share market. We understand that, and consensus was originally expecting Aussie rates to top out at around 3.8%. But after Tuesday's move, the market is now expecting rates to peak at around 4%. And you can see that with the chart on screen. And this change has caused the market sentiment to be weaker over the week. Now, the RBA's actions are obviously in response to Australia's high, stubborn inflation print.
That's right, Kien. The Consumer Price Index, or CPI, over the past year to the December quarter reached 7.8%, which is the highest level since the 1990s. While the CPI print remains sticky, the RBA is forecasting inflation to decline this year, and this is due to global factors as well as slower growth in domestic demand. The central forecast is for CPI inflation to decline to 4.7% this year and to around 3% by mid-2025. If this does occur, then it should support company profit margins in the second half of 23 and also the first half of the 24 reporting seasons.
Jace, let's hope the inflation print eases sooner rather than later, as a number of those companies, particularly the zombies, are unlikely to survive in an extended interest rate hike environment. But how's the health of the market looking as we head into this reporting season?
Well, as interest rates continue to track higher, we are increasingly cautious about insolvency risk. Our research indicates that the proportion of marginal and distressed companies on the ASX remains elevated at around 23% and 41% respectively. Just last month, we observed a design and engineering firm 3D Metal Forge, 3MF, go into voluntary administration. The company has only been listed on the ASX for a little over a year. Investors need to remain vigilant in these times of heightened uncertainty.
And reporting season, it provides that opportunity for you to really reassess your portfolio using some of Stock Doctor's tools. But thanks for the wrap-up, Jace. Onto this topic of Star Stock highlights this week. Now, general insurer and banking group Suncorp, they release their first half 23 results, which appears to be well received by the market, up 4.5% on the day.
Yeah, it was indeed a solid result. The positive share price reaction was driven by better than expected margins across both its banking and insurance divisions. More so, Suncorp's insurance margins were marginally ahead of its closest peer, IAG Australia, who revealed softer than expected first half 23 insurance margins in its latest trading update on the 3rd of February.
Yeah, overall, Suncorp is well placed to grow its earnings and dividends over financial year 23, as the environment of rising interest rates and also inflationary pressures, it provides that support for robust premium growth and also net interest margin expansion within its banking sector. And this has supported the group's positive earnings revisions over the last 3 months.
Also, with the stock trading at very attractive gross dividend yield of around 8%, along with strong capital appreciation over the last 6 months, income investors should be very pleased with their holdings. Just remember, the stock is due to go ex-dividend on the 14th of February, which provides some relief for those looking to stretch the Valentine's Day budget, Kien.
Yeah, that's right, Jace. Not for me though, because I've just had a baby. But yes, Suncorp, like many insurers, are benefiting from rising interest rates due to the higher yields on its investment portfolio, which is predominantly invested in fixed interest securities. Also, investors should be mindful that the Suncorp is in the process of offloading its banking division to ANZ, and this could potentially free up funds for a special dividend or even a share buyback. And now moving on to the REIT sector, the property space, Star Income Stock and Industrial REIT, BWP, they reported a flat result as rental growth of around 4% was offset by rising interest expenses and also prior asset sales. Management did comment that dividend shortfalls in operating earnings would be covered by its cash balance. But Jace, do we believe this is sustainable dividend policy?
Well, this sounds unsustainable in the long run. I mean, using cash balance to fund its dividends, but this has always been part of BWP's strategy, considering it has been a net seller of assets over the past 2 years. What this means is that the net property income has stagnated due to fewer properties in the portfolio. Now, the logic behind this is management's decision that property values have been at record highs. So BWP wanted to use the market's enthusiasm and sell non-core assets in dislocated regional areas.
Yeah, thanks for providing the explanation, Jace. But it's also important to point out that BWP is in a very strong capital position right now, and it can purchase assets at a discount should opportunities arise, which would help increase its dividend alongside its annual rental growth of around 4%. So while we are still reviewing its financials, we tend to like BWP as it's a highly defensive portfolio of industrial assets, predominantly leased to blue chip tenants, such as Bunnings Warehouse.
That's right, Kien. Now, having a look at the corporate calendar, many companies will be releasing their interim results next week. Some of the interesting star stocks reporting include Car Sales, CSL, Commonwealth Bank, Pro Medicus, and Deterra Resources. Star Income Stock Commonwealth Bank will also go ex-dividend on the 16th of February. Please visit Stock Doctor's corporate calendar for more information.
And now for Under the Microscope this week, we take a closer look at Star Growth and Star Income Stock Macquarie Group. The financial conglomerate, they released a positive third quarter update. And for those not familiar with Macquarie, it comprises of 4 operating divisions. You've got the asset management, the commodities trading division, capital markets, and also banking as well. But the bulk of its earnings comes from asset management and capital markets, which really is involved in activities such as equity or debt raising.
That's right, Kien. And over the past year, the volatility across commodity markets has benefited Macquarie's commodity division, and this resulted in a performance that was ahead of expectations. The earnings derived from the profitable trading activities within the energy and oil and gas markets have spurred positive consensus price forecasts or revisions, and this now suggests that FY23 earnings per share should only experience a low single-digit decline versus FY22. From an income perspective, the light moderation in earnings should not jeopardize the group's ability to increase its dividends, as the forecast payout ratio of around 56% remains unstretched.
Yeah, Macquarie is more of a growth play than a dividend play, but that 4% yield is still quite attractive. But thanks, Jace. Though I do wonder, though, how reliable are the consensus forecasts at this point in time?
Great question again, Kien. Historically, earnings from the commodities division has been difficult to forecast, and this is due to the correlation to unpredictable commodity prices. However, over the past 3 quarters of Macquarie's financial year has been completed, and with only 3 months left to go, we are increasingly comfortable with where consensus earnings are placed right now, especially with 12 covering analysts on the stock as well.
And Jace, looking at the share price of Macquarie, the company has staged a strong rally since October last year for investors. So does this still represent an opportunity?
Well, in terms of opportunities, investors can refer to the valuation of the company, which is currently trading within its fair value range, or even observe the stock's forward price to earnings multiple, which is slightly below the industry and market average PE.
But of course, we just got to be mindful that a stock like this, you've got to invest for the longer term because there is some correlation with commodity prices and also financial activity worldwide. So just be mindful of that. And by now, investors should be well aware that rising interest rates is a headwind on equity valuations because the future company cash flows are being discounted back on higher rates. However, the Australian market seems to have outperformed the US and is trading close to all-time highs. So the key question this week is, what has driven the rally in the Australian market? Well, this seems counterintuitive, but if you think about it, the All Ords Index is driven by a huge weighting in the resource names and the banks. And resource stocks have rallied strongly over the last few months.
They certainly have, Kien. The Chinese reopening and abandonment of COVID-0 has provided this tailwind. As Australia's largest trading partner, a recovery in the Chinese economy provides a positive outlook for Australian companies, especially those exposed in the resources and mining sectors. This helped drive investor confidence and pushed the value of stocks like BHP and Rio Tinto, which has a large weighting to the Aussie indices.
And let's not forget, many companies in Australia have been able to maintain strong earnings, which has helped to support their valuations. And this can be attributed to the lower inflation cost pressures, which have made it easier for companies to manage their profit margins. Other factors include the increasing chance of a soft landing for the Australian economy as well, Jace.
Also, don't forget, Kien, that Australia's unemployment rate remains quite low, and this suggests that the economy is strong with bad debts under control. This has also boosted the profits of financial firms, including the banks, which tend to be a bellwether for the economy. Meanwhile, retailers like JB Hi-Fi and Super Retail have also guided for better than expected earnings.
Yes, and regardless of where the index is trading at, Jace, there are still plenty of opportunities within the mid to small cap space. And this reporting season will continue to confirm those fundamentals behind those quality businesses across our star stocks. Thanks for your contributions, Jace. Pleasure to have you on board as always.
Pleasure was all mine, Kien.
And also just remember to tune in for Lincoln Live on Monday. We'll have our senior portfolio manager, Matthew Swartz, our research analyst and Stock Doctors expert, Rob Manfrey, to discuss reporting season highlights, portfolio strategy, and also how to use Stock Doctor. Well, to summarize today's episode, rising interest rates, they can weigh on share market valuations, but this may not always be the case. Hence, investors should separate the facts from the noise and concentrate on building a portfolio of high-quality businesses, companies with strong financial health and resilient earning streams that can withstand the stress of higher interest rates. Take care and have a happy, healthy, and prosperous week ahead.